All right, good afternoon, everybody. So my perspective is working with small companies often come to us looking for their first round of outside equity capital. So I know this session is going to be broader in terms of type of capital, but I'm looking at this in terms of if you were going to find an outside investor, say an angel investor, small venture capital fund, something like that. So a few things. I was asked to give some tips on things to think about before you do this. I've looked at literally hundreds of business plans, talked to a lot of entrepreneurs over the years, and here's a few tidbits that I can share with you. So first question I always want to ask somebody before they go into this process, are you really sure you want to do it? It is a big deal to go and raise equity into your business, and it's not something that you should do lightly. I've occasionally met folks who sort of feel like it's a normal progression. Well, I start here, I do this, and then I have to raise capital and I go here. And I like to tell people you don't really have to raise outside capital depending on the business that you're in. Try to figure out how to do it without outside capital if you can. I know some people would prefer, oh yeah, we want to have the capital, but it really is so difficult that I encourage you to try to make sure you can't do it in other ways. Now when I talk about other things than outside capital, grants are an obvious choice that are non-dilutive. Yesterday we heard Robert Johnson talk about friends, family, and fools. So friends and families is an obvious choice for getting capital. I don't consider that outside capital because they're lending to you, or giving money to you because of you. But the last one is one that I've seen more of in recent times. If you have a business that has a unique idea, a unique service that you're offering, consider going to the people you're going to be providing it to help provide you funding. One of the largest sources of funding that you need is to finance your working capital, your receivables. So I've seen a lot of companies go, can I get deposits from customers? Can I get shortened payment terms? And if you're really offering something that's in demand and unique and different, there's a chance you can make it work. So I think it's really a good idea to explore those areas of getting capital before you start looking for an outside investor. Second thing I like to talk to entrepreneurs about is where do you really want to go? There's a whole lot of entrepreneurs out there with some wonderful ideas for companies that their dream is to run this company for the next 20 or 30 years, or to build a company so that I can get a nice salary, take a few weeks of vacation, life can be good. And those are all good reasons to run a company, and there's nothing wrong with doing any of that. But just be aware that that's really not going to resonate too well with outside investors. There's really a very small segment of the business world that's really set up for outside equity investors, because those outside investors are going to look to get in, have you grow the company, and you're going to need to flip it and get out. So I think you really should consider carefully before you go down that path. Third thing to think about, and I've seen this many times, is a lot of people really like the idea about getting money to build their business, but they don't really think about the fact that once you have an outside investor, it's not really your business in the same way. Sure, you still might be the majority shareholder. You still can make most of the calls, but at the end of the day, you have to deal with these outside investors. You're probably going to have a board of directors that you have to answer to. You're just not going to be able to make those quick, knee-jerk decisions the way that you did, or if you do, you're going to probably run into objections from your shareholders. So I think it is one of the things to be aware of. There's a lot of time involved. I sit on the boards of a couple of startups, early stage companies, and the CEOs, the entrepreneurs, are amazed at the amount of time it takes to manage outside investors and manage outside board members. We're not an easy group, so you gotta work with us. Third thing, I hear a lot of entrepreneurs when they get involved with us trying to raise money, and they just can't believe it when we get into it and saying, wow, you want to get 10 times your money back? I mean, come on. Yeah, why do you need 10 times your money back? Here, I'll give you a deal, you can get 15% return. I mean, in today's environment, wouldn't you love a 15% return? Well, the problem is, yeah, I would if I'm sure I'm going to get the 15% return, or pretty good, likelihood. But investing in startups, early stage companies, very risky. And so when you're looking at a deal, when an investor's looking at a deal, they're expecting to lose their money a significant portion of the time. I've seen a lot of studies say half the time you're going to go to a zero. So when an investor is evaluating your company, they're actually looking at the whole portfolio possibility. They don't know for sure if you're going to make it or not, but if you do make it, they want to think there's a pretty fair shot of getting a big number back, 5, 7, 10 times their money back. And so a lot of times that just strikes people as, whoa, this is unreasonable. Well, in the scheme of the asset class and the risk that they're taking on, really not. So it's something to be aware of. I've often heard a lot of people when they're working with us trying to get money that they just can't believe when I start saying, well, we need more proof of that. We need to minimize this risk. And I've heard people say, come on, you're in early stage investing. You got to take risks, right? I mean, come on. And you go, well, okay, but the fact of the matter is we're seeing a lot of different deals, and the goal is to minimize the risk as much as we can so we can increase the probability of getting the big return. And there's all kinds of risks that show up in an early stage deal, and I listed some of them. You can have technological risk. We look at a lot of deals that have IP, intellectual property, and different kinds of things, and there's questions, will it really work? Because we're often investing before you have the product completed. Execution risk. This is, you might have a great product and a great idea, and the question is, you got to take it to market. You really going to be able to take it to market well or not? That's a tough thing to do. Robert Johnson talked about sales and marketing and how important that is. That's called execution risk in my mind. And so a big deal, and how you can show that you can minimize that. It's very important. Market risk. I invested in a company years ago, and our biggest question was, well, really, how many people are really going to want this product? It was a great product. It had patent protection. It was fabulous. Nobody else had anything like it. Like, well, but do enough people really want this thing that the market's going to be big enough? That's a risk. You got to factor it into your pricing. And the last one that I put up there is a huge one that I pay attention to all the time now, which is financing risk. And this is something that often entrepreneurs don't think about this. We frequently see deals where somebody will come in and say, yeah, I need to raise, let's call it $500,000 in the first round, and my plan is we're going to develop to this point, and then we're going to raise $1 million, and then we're going to go down here, and then we're going to raise this, da-da-da-da. Well, my mind turns off somewhere after that first raise, because financing risk is, well, you get down that road, and have you really progressed far enough that you're going to be able to raise that second round? It may sound great up front, but you're going to be into the game a good bit. If you stumbled, things didn't quite go quite as well, then you're going to be in a situation you're running out of money and you're desperate for money. And typically what happens is the guy who put their money in the first round gets squashed when that happens. And so financing risk is a big deal. And it's one of those things I encourage entrepreneurs that I work with. You really need to figure out a plan when you can do this in just a couple of rounds at the most. Back before the meltdown, we used to see all kinds of deals, biotech deals, deals with lots of later round financing. We never worried about it. Those days are gone. So be aware of what future financing you think is available. And your job as an entrepreneur is try to minimize all these areas of risk, even though you may say, well, I'm minimizing the risk. Why do you want to get 10 times your money? Well, it's the way it is. We got it. We want to make it happen that way. Pre-money values are lower than they should be. So I hope you guys are familiar with the term pre-money value. That's the value you place on the company before the money gets invested in the company. So if your company is worth $100 and you raise $50, the person who puts the money in doesn't get 50% of the company. They actually get 33 1/3% of the company, because that 50 goes into the company. So it actually, then the company that posts money is $150 and you have $50 in. So it's really just a way of talking about what percentage of the company are you giving up for the amount of money that you're putting in. And one of the things that investors do is they use pre-money value as a way to offset the risk. So when we see deals that have more risk, well, the value is going down, because really that's all we can do, in the hopes that, well, maybe if it doesn't get the home run, it can still get a reasonable return. And so I hear a lot of complaints. Why is the value so low? My company's great. Well, okay, go find money somewhere else. It's a very difficult game, and you're going to have a situation where you're probably going to get beaten up on your pre-money value. Sort of fact of life these days. Next thing, you gotta think about your exit. I've seen so many entrepreneurs, I think, really just mess up from the get-go when they come in and they're so excited about their company. Oh, this is great. I've dreamed of doing this my whole life, and we're going to go here, and I'm going to be the king of the world. And I'm just thinking, no way in the world I'm investing in you. Why? Because I don't want him in love with that company. I want him in love with building it to this level and selling. And so if he loves the company that much, I got a real problem, because it doesn't do me much good if he builds a nice company. Yeah, it's better than having a company go broke, but I don't get a return until he actually sells the company. So if you're seriously thinking of going for outside money, you better be 100% comfortable with the fact that you're okay with selling out. In fact, you want to sell out. And the best pitch that I've ever heard for that is the one Robert used it the other day. Hey, my goal is I'm going to build this up. Going to make a pile of money, going to turn around and do it all over again. You know, that's Carolina. So I don't know what the sale is in Jamaica, but you know, you got to know your market. You got to know what you're going for, and it doesn't do you good to say, oh, this would be a great company if I were in Boston. Well, then go to Boston if that's what you think. But if you're here, you got to sell the way the investors are thinking about it here. So I do think it's make sure you talk to folks before you get committed to what your value is and your rules are. You know, go in and say, this is what I'm thinking about. What would you recommend? And people will share with you, and you can hopefully learn so that when you do go to market, you can be successful and raise the money and build that great company that you always wanted. So thank you very much. That's all I have to share.